Welcome back to the Pro Checker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Glad to be here.
And what a way to start December 1st, 2025. This deep dive is necessary because, well, the markets are opening the final month of the year with some extreme volatility.
It's true. We're seeing major central banks pulling in completely different directions.
Yeah, and at the same time, this significant risk-off panic in speculative assets like crypto, plus growing opacity around China, Wall Street futures are sliding as investors just try to make sense of it all.
It's a moment that really demands perspective, and that's our mission for this deep dive. We're going to synthesize a truly global stack of inputs.
Okay.
From those surprising signals coming out of the Bank of Japan, the fundamental cracks we're seeing in China, all the way to that sudden sell-off in Bitcoin.
So the goal is to pull out the actionable knowledge.
Exactly. We'll be drawing from what Bloomberg, CNBC, and Yahoo Finance are telling us, so you can filter out the noise and, focus on the long game.
All right, let's unpack this policy tension, because the biggest shocker this morning, it didn't come from Washington. It came from Tokyo.
From the Bank of Japan.
We're talking about the Bank of Japan. According to Bloomberg, BOJ Governor Kazuo Ueda just delivered the clearest signal yet that a rate hike could be coming at their December meeting. It's an absolute U-turn.
It is a stunning hawkish turn. I mean, for a central bank that's been the global symbol of ultra-low rates for decades, this is huge.
So what were his exact words?
Ueda's exact words were that the BOJ will consider the pros and cons of raising the policy interest rate. Now, he tried to frame it as just adjusting the degree of easing.
But the market didn't hear it that way.
No. The market heard one thing. Rates are moving up.
And the immediate measurable consequence was felt deeply in the bond market, wasn't it?
Absolutely. The 2-year Japanese government bond, the JGB, its yield immediately rose to the highest level since 2008. Wow. And for you, the listener, the significance here is enormous. If Japan starts raising rates, it affects global capital flows. Japan has been the primary source of cheap funding for the world for a long time.
The famous carry trade.
That's the one. Higher JGB yields mean the cost of borrowing goes up for Japanese investors holding foreign assets. And that could force them to unwind those holdings. It's a subtle but powerful source of global market instability.
So how are traders betting on this now, after this shift?
Expectations have just rocketed. We're looking at an index of overnight swaps, which is basically where the big institutions bet on where rates will land.
Okay.
Before Ueda spoke, the chance of a December hike was pretty low. Now it's pricing in about a 76% chance.
76%? That's a massive jump.
It is. And the yen immediately jumped against the dollar, which is the textbook reaction.
Yeah.
They're preparing for the end of the zero interest rate era in Japan.
Okay, now, here's the striking contrast. While Japan signals tightening, here in the U.S., the expectation is for rapid easing.
A complete divergence.
Our sources from CNBC and the CME FedWatch Tool Show traders are pricing in an 87.4% chance of a quarter-point rate cut by the Fed at the December 10th meeting.
That is an incredibly high market expectation, almost a certainty, which that usually raises a red flag in terms of pricing risk.
Yeah.
But the political context here is undeniable.
Right.
We saw Bloomberg reporting that President Trump has announced he's already decided on his choice for the next Fed chair, and he's made very clear what he expects.
He expects rate cuts.
Interest rate cuts, yes. And the presumed frontrunner, Kevin Hassett, seems to be actively trying to reassure the market he's the right choice for that job.
Citing the positive reaction to the rumor of his nomination.
That's where the mechanism becomes so clear for the listener. Hassett pointed out that yields fell following the speculation of his appointment.
And falling bond yields mean cheaper borrowing costs.
For everyone. Mortgages, corporate debt, car loans. The market is interpreting his potential appointment as a clear signal that the political objective economic stimulus via cheap money is going to be achieved. Fast.
So it just underscores this profound policy split. Japan tightening, while the U.S. is anticipating cuts, possibly fueled by a political mandate.
A fascinating setup for the end of the year.
Okay, let's connect the dots to China. That BOJ news, combined with fresh, complicated data from Beijing, it left Asian markets pretty mixed. The economic picture in China remains fundamentally worrisome.
Especially in manufacturing.
So what are the private and state-backed surveys telling us?
The November Purchasing Managers Index, or PMI readings, they continue to signal this entrenched weakness. And remember, the PMI is an indicator of economic health. Anything below 50 means contraction.
Shrinking activity.
Right. The official manufacturing PMI, which tends to favor the big state-owned companies, it edged up a little to 49.2, but has now been in contraction for 8 straight months.
8 months. But the real anxiety is in the private surveys, isn't it? They often give a truer reading of the smaller, more export-oriented businesses.
Precisely. CNBC highlighted the private rating dog China General Manufacturing PMI, which unexpectedly contracted. It dropped to 49.9 and missed analyst estimates.
Which were above 50.
Right. They were expecting 50.5. The fact that these export-oriented firms, the backbone of global trade, are struggling more severely tells you something about persistent global demand weakness.
And this is dragging everything else down with it.
It is. The non-manufacturing sector, so services and construction, that also fell to 49.5. This whole ecosystem is being dragged down by the massive, festering wound that is the Chinese real estate crisis.
And speaking of real estate, this is where it gets really interesting, or maybe really worrying. Bloomberg pointed out a massive issue around transparency.
The data just disappeared.
Disappeared.
Yeah, this is maybe the most unsettling data point of the day. 2 major private data agencies, CRIC and China Index Academy, which track home sales. They didn't release their November sales figures for the top 100 developers.
And they said this was at the government's request.
Explicitly. When data disappears like that, it's usually a signal that the situation is far worse than what's being officially communicated.
That lack of transparency just skyrockets the risk profile for anyone investing there.
It does. And this comes right on the heels of that news about China Vanke, a developer everyone thought was fiscally sound.
And now they're facing potential debt issues.
Potential debt postponement, yeah. And for context, the last public reading we got back in October already showed new home sales for the top builders slumped almost 42% year on year.
So when you suddenly withhold that kind of crucial market data, especially in a sector that's already hemorrhaging,
the uncertainty just increases exponentially. It makes any kind of long-term capital commitment almost impossible.
So we have policy divergence and Chinese opacity contributing to a severe risk-off start to December. And when investors pull back from risk, they pull back from speculative assets first.
That's right.
And Yahoo Finance and Bloomberg confirmed the crypto sell-off has resumed with a vengeance.
We're seeing a significant tumble. Bitcoin slid as much as 6%. It dipped to below $86,000 for a bit. Ethereum got hit even harder, falling over 7% to about $2,800.
A painful start to the month for anyone holding those assets. What specifically kicked off this fresh wave of selling over the weekend?
I'd point to a couple of primary drivers. First, regulatory friction. The People's Bank of China issued a very stern warning about illegal activities related to digital currencies.
Which they've done before, but this one seemed to have more teeth.
It did. This specifically caused Hong Kong-listed financial stocks tied to crypto, like Yunfeng Financial and BrightSmart, to tumble over 7%. The message is clear. Regulatory risk is still very high, especially in Asia.
And second, it sounds like the fundamental market structure just isn't holding up.
That's the structural problem. There's this persistent concern over really meager inflows into the new Bitcoin ETFs.
The ones that were supposed to bring in a wave of institutional money?
Exactly. And coupled with that, we're seeing a distinct lack of dip buyers, the people who usually step in when prices fall to provide some support. They're just not there.
So what's at the next level to watch?
Bloomberg's analysis is pointing to $80,000 as the next critical support level for Bitcoin. If that level breaks, it indicates a real structural erosion of confidence that could lead to much deeper losses.
Okay, now in a truly bizarre twist, while speculative risk assets are melting down, we're seeing bullish moves in tangible assets, specifically key commodities.
This contrast is very telling. Oil, for example, is gaining traction. Brent crude is trading above $63 a barrel, and that's according to Bloomberg data. It's driven entirely by supply risks.
What was the trigger?
Over the weekend, there was an attack that damaged a key Black Sea pipeline terminal. Any disruption to a major energy transport line like that immediately adds a geopolitical risk premium. Plus, you have ongoing tensions with Venezuela fueling supply jitters as well.
And then there's silver. I mean, its performance this year has been historic.
Historic is the right word. Silver has been running hot all year. Bloomberg reports it just jumped to a fresh peak of $57.86 an ounce. It has doubled in value this year.
Doubled.
Outpacing even gold's impressive 60% rally.
So what are the drivers there? It's a perfect storm, it seems.
It is a perfect storm.
Uh,
You have fundamental supply tightness. We're seeing a historic squeeze in London. Metal inventories and inventories in Shanghai are at near-decade lows.
Mhm.
And that's combined with the speculative momentum we were just talking about.
So it's a tangible asset benefiting both from tight industrial supply and the expectation of a U.S. Fed rate cut.
Exactly. A rate cut generally weakens the dollar, which helps boost dollar-denominated commodities.
So it's getting a tailwind from both sides.
It's benefiting from both the industrial demand narrative and the monetary easing narrative. That combination is proving incredibly powerful right now.
Okay, so given this chaotic blend, BOJ tightening, China opacity, crypto melting down, silver surging, it's a textbook definition of market noise.
It is.
And this is exactly the moment we need to pull back and recalibrate. Focus on the long term, drawing from Warren Buffett's wisdom and the 10 truths that were outlined in Yahoo Finance.
This is the essential psychological shift you have to make. The first and most critical truth is simple. The long game is undefeated.
Right.
Buffett often reminds us that despite 2 world wars, the Great Depression, dozens of recessions, financial panics, the Dow rose from 66 to nearly 11,500 over the 20th century.
And the hard data backs that up.
Completely. Since 1926, there has not been a single 20-year period where the U.S. stock market didn't generate a positive return. Time is your most powerful asset, period.
But that doesn't make the day-to-day grind any easier, which is why we have to immediately address truth number 2. You can get smoked in the short term.
Oh, absolutely.
Even in years when the S&P 500 finishes positive, it experiences an average intra-year drawdown, a decline from its high point of 14%. That 14% drop is not an anomaly.
It's the price of admission. It's the necessary, painful price for those long-term, undefeated returns.
And this connects to truth number 3, right? Valuations tell you very little about where prices are headed in the next 12 months.
Yeah, this is key. When you're looking at short-term price movements, like silver surging or crypto plunging, it's often about market momentum and narrative, not strict price-to-earnings ratios.
So expensive things can get more expensive.
And cheap things can get cheaper. The market narrative just takes time to change.
Which brings us to truth number 4, one that should give a little comfort on a morning like this. There will always be something to worry about.
Always. Right now, we're worried about the BOJ, China's transparency, the crypto structure. But those are the known risks. The truly destabilizing risks, the ones that cause severe market pain, are the ones people aren't talking about.
Because they haven't been priced in yet.
Exactly. So the investor's job is not to eliminate worry, but to tolerate it.
Shifting gears slightly, this market performance, particularly the post-2020 surge in tech, AI, and home values, has profoundly accelerated what economists call the K-shaped economy. And CNBC had some fascinating data on the real-world impact of that wealth concentration.
It shows the gap widening, and widening rapidly. The K-shaped recovery means the top segment of the population saw massive wealth appreciation while the bottom struggled.
And they quantified it.
They did. The threshold to be in the top 10% of U.S. households by net worth grew from $1.3 million to roughly $1.8 million in just 5 years. That capital appreciation is just accelerating the wealth divide.
And this widening gap creates unique entrepreneurial opportunities for people who can serve that high net worth group. We saw a great example in the CNBC profile of Tayo and Dulu Lanlahin and their side hustle, Bay Area Kids Rentals.
Their story perfectly illustrates how to target that upper leg of the K-shape. They started with just $2,000, and now they generate over $295,000 in annual revenue.
How?
By focusing on serving high-net-worth clients, Silicon Valley executives, professional athletes who demand luxury, flexible, and utterly seamless service.
What was the specific insight that separated their business from just a regular rental company?
It was all about eliminating friction points. Tayo mentioned that they incorporate potential deposit costs into their pricing instead of asking for a separate deposit.
A small thing.
It sounds small, but for their high-end client base, that little logistical adjustment reducing administrative hassle, reducing paperwork, is highly valued. It proves that in the service economy targeted at high-net-worth individuals, convenience is a critical differentiator.
They're capitalizing directly on the reality of that K-shaped recovery.
A wonderful illustration of opportunity meeting demand, and a reminder that solving a niche problem for people willing to pay for premium execution is a resilient business model, even when central banks are clashing.
Okay, so we've covered the massive policy divergence with the BOJ signaling tightening while the U.S. anticipates easing. We've hit the high-stakes risk around China's data opacity, the painful crypto sell-off, and the essential resilience you need for long-term investing.
A lot to unpack.
A lot. Before we close out this deep dive, let's leave you with one final provocative thought. It's about year-end financial decisions. We are heading into a crucial period before the tax landscape shifts significantly next year.
Largely due to the sunset of President Trump's Big Beautiful Bill, as reported by CNBC. If you are a high-income individual who itemizes deductions, you need to seriously consider bunching your charitable donations.
Bunching them into donor-advised funds, or DHEFs, in 2025.
Yes, and the timing is so important right now.
Why?
Because you can take a large upfront deduction in 2025 before the new tax floor and the top bracket cap hit in 2026. The itemized deduction floor is set to rise, and you'll need to exceed 0.5% of your AGI before you can even claim them. Bunching your donations now maximizes your deduction before that higher floor kicks in.
So for high earners, donate big now to lock in the better deduction rate. But what about the average person making smaller cash gifts who doesn't itemize?
For non-itemizers, the advice actually reverses slightly. You might benefit from waiting until 2026.
Okay, how so?
The new legislation introduces a new, smaller, non-itemized deduction for charitable giving up to $1,000 for single filers, $2,000 for married couples filing jointly. If you don't itemize, waiting until 2026 might be the path to claiming a deduction you otherwise couldn't access.
It's crucial tax planning then, before the entire framework shifts.
Excellent context for anyone closing out the year.
Indeed.
We'll see you all tomorrow morning with new headlines from major financial magazines.